PepsiCo has the hottest ticker page on Yahoo Finance right now as the food giant blew away profit estimates and raised its full-year forecast for sales and earnings. Joining us now is none other than PepsiCo Vice Chairman and CFO Hugh Johnston. Hugh, great to see you as always. You just got off the earnings call. I was on the earnings call as well. I think the street was very surprised by how strong your sales came in. Is this the reality that your business is still going to do pretty darn well even in a mild recession?
Yeah, good morning. Nice to be with you guys. You know, I think it will. Historically, we have done well as we've moved into recessions. Obviously, a 16% growth rate for PepsiCo is an extraordinary number. But that said, we do think that we'll continue to perform pretty well, regardless of the economic environment. One of the beauties of consumer staples is while people may trim their purchases in durables and more higher end goods, in a difficult environment, people want a bit of an affordable luxury, and a bag of chips or a beverage is something that they can treat themselves with and give themselves a smile. So we should perform well through good and bad economy. I'm
all for smiles, Hugh. Absolutely. Are you still pushing through price increases, though, in the fourth quarter?
We did. Beginning of the fourth quarter, we took some more pricing. Again, all of that is based on commodity input costs, which continue to be higher. For the year, we'll be in the high teens in terms of our commodity input costs. So our pricing has been a little bit less than what we've experienced in inflation. But frankly, we focused on all the other aspects of our cost structure as well. So while gross margins were down a bit, operating margins were up as we've managed the balance of the cost structure very tightly.
Hey, Hugh, it's Julie here. Just want to dig into pricing a little bit more. So average price is up 17% year over year. Average sales volume, or overall sales volume, I should say, went down a little bit. How much are you going to be able to continue to raise prices? And do you expect volumes to continue to trend lower?
It's a great question. We started the year with relatively high pricing, and we assumed that, in fact, volumes would do worse than what they have. A whole variety of reasons as to why that's the case. I think for number one, prices are increasing everywhere, not just in our categories and in our company. Number two, household balance sheets for at least the upper 8 deciles are still remarkably strong here in the United States. So as a result of that, we think we can continue to take whatever pricing we need to address the commodity inflation that has actually impacted us. In terms of that inflation, you guys know, and we've talked about in the past, we tend to forward buy on commodities about 6 to 9 months. So as we see some moderation in commodities, we'll be able to manage our pricing going forward. But that's going to be a delayed effect because of our forward buying.
What type of replenishment have you seen among your partners, your channel partners who are selling through so much of the inventory that you do produce, especially knowing that consumers who are looking for deals, they might be buying in bulk for some of the products that you offer, that you bring to the market in order for themselves to be able to see some type of deal on their side?
Yeah, it's less an issue for us than I think is elsewhere. Because our number one, our salty snack products have a limited shelf life, so you really can't buy too much in bulk on those products. And then on beverages as well, because our pricing tends to be relatively even. We used to do much more high-low in terms of pricing. It's now a little bit more level. So the desire to sort of load in on those products when the prices are low, that opportunity doesn't exist anymore. Candidly, we think that's better for the consumer. And what we've seen is consumers look at the category more favorably when the pricing is more consistent. So given that we control distribution all the way to the shelf for the majority of our products in a number of markets, that load-in factor is really not an issue for us the way it might be for some other companies.
Hugh, let's talk currencies for a moment. You guys say now the currency transition is going to cause about a 2.5 percentage point hit to the top and bottom line for the full year. That's up 0.5 percentage point from previously. We've been watching all kinds of wacky currency moves, particularly when we talk about the British pound and the actions that the Bank of England are taking. I think you guys get about 2.5% of your sales from the UK, if I'm not mistaken. How much of a problem are central banks? How much of a challenge, I guess I'll ask that more diplomatically, is that posing for you in your business?
I mean, currency, whenever the dollar is strong, obviously impacts our international profits when we dollarize them. That said, at a 2 or 2.5% level, we view it as relatively manageable. we don't hedge on translation of earnings. We only hedge transactions. Frankly, because hedging translation doesn't create any real economic value. In fact, it has a cost to it, so it destroys economic value for shareholders. So, but at the level we're at right now, we view it as a manageable issue, not something that's going to be disruptive.
Hugh, you got some questions on the call about Gatorade. Early next year, I would say you're making a big push into caffeinated Gatorade via a product called Fast Twitch. I mean, 200 milligrams of caffeine, that's a lot of caffeine. How big a role do you think Gatorade will play in the energy drink market starting next year?
Well, Gatorade broadly is doing really, really well right now. The base Gatorade Zero is probably going to be $1 billion business pretty soon. G-Fit, the product that we introduced earlier this year, is capturing occasions outside of the core sweat occasion for Gatorade. So we think that franchise is very extendable. One of the places we've seen athletes, and Brian, I suspect you probably use a product like this as well, as athletes will use caffeine as a mechanism for driving performance. We viewed it as an opportunity. We certainly got requests for it from some of the professional teams that frankly use it as a performance assist as well. So we decided to launch the product, and we think it's going to be a terrific product. How big it'll be, hard to say at this point, but we do know there's a market out there. We're excited to participate in it.
Hugh, while we have you, in the market that we see right now where valuations have significantly lowered, do you see more of an accelerated opportunity for deal making, for looking at some of the brands that have looked kind of acquisitive or tasty, if you will, for a company in Pepsi and bringing them on board?
Well, we've done a few deals over the past couple of years, and obviously we like to spend the time to make sure that we integrate those deals properly in order to ensure we get the success we anticipated out of them. Look, the reality of it is we look at everything. Anything that's close to our space, we'll always take a look at. At the same time, we're very, very disciplined in terms of the way that we approach actually executing a transaction. So. Yeah, I agree with you. Valuations are down, but just sometimes something isn't inexpensive. It just costs less than it used to.
All right. Wise words there. PepsiCo Vice Chairman and CFO Hugh Johnston. Hugh, thanks as always for taking the time with us.
Thank you. Good to be with you guys.